afternoon, and welcome to Eligibility for PPP Loans under Round 2. My name is Dana O'Donnell, Director of Marketing with Schaeferman Laken. Attorney Scott Borsak, who is a partner and chair of the Schaeferman Laken Business Department, will be presenting today's program. Before we get started, I want to let everyone know that today's webinar is being recorded and will be emailed to you within 24 hours. It will also be available on our website, schaeferman.com. Should you want a copy of the presentation slides, you can download from the Handouts tab. Scott will also be taking questions at the end of the presentation, so please submit your questions on the Questions tab, and we will try to get to as many as possible. Let's get started. Scott?
Thank you, Dana. Good afternoon, everyone. Happy belated New Year to you all. I know that it's been a couple of months since our last webinar, and changes in the area of PPP came to a near grinding halt over the last 2 or 3 months, with a lot more activity leading up toward the end of the year. We had a little bit of a cliffhanger waiting for the Consolidated Appropriations Act to be signed, but finally have some new legislation. And as we sit here, there is some new opportunities for existing borrowers in a new program and modifications to the forgiveness process. So today we're going to focus on eligibility for Paycheck Protection Program loans under what's being called Round 2. Some of you may be more comfortable thinking of this as Round 3, in that there was a second round of loans that was provided under the old set of rules. Either way, we're dealing with something familiar, but also something a bit new here. Okay, so because I'm a lawyer, I have to start with traditional disclaimers. That this program is intended for educational, informational purposes only. Nothing in this program is intended to constitute legal advice or to create an attorney-client relationship, and that you need to formally engage an attorney to receive legal advice, which can be through a consultation. So, as an introduction to Round 2, as I mentioned, the President signed the Consolidated Appropriations Act on December 28, 2020, in the waning days of last year. The Act contained provisions for the creation of this Round 2 with new elements and some drawn from the CARES Act program. Round 2 most notably allows for loans of up to $2 million, and if you remember, under the CARES Act program, the limit was $10 million. If past experience holds, we're going to see lenders inundated with requests, and they're going to be overwhelmed with their applications. Funds are going to be committed very quickly, is my guess. If you remember, when PPP first came out in the end of March, beginning of April of last year, most lenders were committed in 5 days or less. So borrowers are going to be have to be ready to act as soon as lenders open their portals, and lenders are likely to use the same means for application in this round as they have used previously. So you probably want to stay close to your lenders. In anticipation of today's program, several people have sent me questions asking specifically about whether they'll be eligible for a Round 2 loan, even though they haven't submitted their application for forgiveness yet in Round 1. And as best we can tell for the legislation, there's no limitation on whether a borrower can submit in Round 2, though they've not completed the process in Round 1. And as I've commented to some of our listeners, my hope is that the SBA is not going to change that by regulatory fiat as they've done in other areas. But there's nothing in the Round 2 legislation that I could see that created that limitation. So if you have a Round 1 loan, you shouldn't be concerned about whether you can apply for Round 2, though you've not been granted forgiveness in Round 1. As was the case with the CARES Act part of this, if a PPP loan is spent on eligible expenses, and we'll be talking later about the categories of eligibility for expenses have been expanded. As we saw in round one, the loan can be entirely forgiven. The Flexibility Act requirement of spending 60% on payroll expenses remains under round two. As was the case before, you can't double dip on some of the relief here. So to the extent that you get a tax credit for qualified sick leave, that's not going to be an eligible expenditure, nor the tax credit for qualified family leave. The amounts you pay in compensation to get that tax credit can't serve as a double dip. But interestingly enough, the employee retention credit and the amounts you spend to get the retention credit are good expenditures for payroll costs in order to get forgiveness. So there is some spread here in treatment of various tax benefits. A big question that I've gotten from a lot of participants has to do with the EIDL grant. Generally, that $10,000 payment that EIDL borrowers have gotten, that is a grant and not due to be paid back to the SBA. But as we saw under the first round, when borrowers applied for forgiveness, the amount of the grant was subtracted from eligible expenditures, so that in essence, the EIDL grant was recaptured. The new legislation removes that recapture provision. So the $10,000 grant is now truly a grant, and you can stack an EIDL grant on top of a completely forgiven PPP loan. So yet another little nuance here in the new law. So the statute provides that the round two loans are benefited by what can be a simplified application for those loans under $150,000. There's going to be a new application that the SBA has to release in the next several days, and that for loans under $150,000, the borrower is just going to have to certify that the revenue loss requirement, which we're going to talk about later, was met, that proof of the loss of revenue does not have to be delivered to the lender until the forgiveness application is submitted. So eligibility is basically going to come on a certification on the application without any proof. So conceivably, the SBA is now telling lenders, take the application, the loan's under 150,000, get that money out quickly, don't review anything, just accept what borrowers are telling you and process loans as quickly as possible. That new application is going to have the borrower certify, as they did in the first go round, that uncertain economic conditions makes this loan necessary to support ongoing operations, and that the funds will be used for eligible expenses. And again, we're going to talk about eligible expenses throughout the program. The borrower is also going to have to certify that they haven't received previous grants which were supposed to fund amounts that they're going to use their PPP loans to fund. So, for example, a not-for-profit that receives a grant to cover payroll can't make a PPP application for payroll expenses because they've gotten other provisions to pay these amounts. This is a new entry into the field here, and did cause some concern for some borrowers in the first round. So if you remember, there was a lot of hand-wringing under the old application for demonstrating economic and financial necessity in order to qualify for a PPP loan. And those 2 weeks in May, around the 14th of May, had the SBA spinning around quite a bit in trying to draw lines to provide borrowers with comfort who were trying to make decisions about whether or not to keep loans in the first instance. Well, a lot of that has been removed from the second round by a couple of developments. First, the maximum loan here is $2 million. If you remember, under the old regime, the SBA said for all loans under $2 million, the SBA was going to presume that the loans were necessary. And it wasn't for loans over $2 million that the SBA said that they would review the necessity determination, but they never spent a lot of time telling us how we could demonstrate loans were necessary. So attorneys and accountants and other advisors spent quite a bit of time doing a bunch of research to put together a matrix to help advise the clients who borrowed more than $2 million as to what they might expect in a necessity audit. Well, in this go round, again, the legislation limits loan amounts to $2 million, and there is a quantitative test. There are numbers here. There's something we can sink our teeth into and be able to draw bright lines to determine when borrowers are eligible or not. So a borrower must be able to demonstrate that their revenue in any quarter in 2020 is 25% less than the same quarter in 2019. So pick a quarter. You can use that quarter, compare it to the same quarter in 2019. And if you've experienced that 25% reduction, you're now eligible. An entity that wasn't in existence until the third or fourth quarter of 2019 can use either the third or fourth quarter for purposes of revenue comparison to any quarter in 2020. So those entities that didn't have a full year's experience in 2019 have some flexibility in this case, picking the highest quarter in 19 to compare against 2020. The entity has to be in business on February 15th, 2020. So new entities aren't going to get any benefit from this program. And again, the point about scrutiny for necessity, the 25% test should eliminate a lot of the questions that we saw in the first go round about over 2 million, under 2 million, and how exactly we can demonstrate necessity. The SBA is also, Congress has also spent some time in delineating something about eligible entities and borrowers. So in this go round, Congress obviously continues that business concerns can apply. They state that nonprofit organizations can apply, and that's generally the 501c3s, educational, scientific, charitable, religious. But there are others like a 503c6, 501, C6 organization, which is basically chambers of commerce. Housing cooperative corporations can now apply. Veterans organizations, tribal Indian concerns are eligible. We've always known that self-employeds can apply, sole proprietors, independent contractors, again, in the carryover from the prior legislation, and now small agricultural cooperatives. Not many of those in my part of New Jersey, but I'm sure around the country there are quite a few that are now clearly in the realm of eligible entity. So an eligible borrower is an eligible entity with fewer than 300 employees. And again, this marks a change from the CARES Act provision, because under the CARES Act, you could have up to 500 employees. So you'll see between the loan amount being reduced to 2 million and now a limit of 300 employees, Congress is trying to get to smaller small businesses and avoid a lot of the hand-wringing and negative publicity that we saw in the first round with large corporations being able to get loans. And you'll see there are a couple other points that we'll touch on that will reinforce this. The affiliation rules still apply, and if you remember, those are the rules that have related entities being stacked up together for purposes of satisfying the size test. So, and we'll talk about the affiliation rules in a moment or two, but if you have 2 or 3 affiliated or related businesses, and each one has 150 employees, though each entity may be eligible, because they are related, they would trip on the size limitation and none of them would be able to apply for a loan. As we saw in the first iteration here, the affiliation rules are waived for an entity with entities with fewer than 300 employees operating with an NAICS code starting with 72, and that's generally the hospitality industry, restaurants and such. And under the first iteration, the cap size was 500, so here we're in 300 as well. And as we saw in the first go round, those very same borrowers with the NAICS code starting with 72 that have multiple locations, each location is now looked at as being an eligible entity, as was the case in the first go round. And again, each location has to have less than 300 employees. So the exceptions to the affiliation rules continue, albeit with a lower cap. And we'll now go through some of the areas of ineligible borrowers. Some may surprise you. So entities that are engaged in operating residential real estate, again, a carryover from the first go round. Those engaged in lobbying or political activities are not eligible. Companies formed under Chinese law. I hadn't known this was a problem the first time through, but Chinese companies now are excluded. Not only formed under Chinese law, but if more than 20% of the equity is owned by Chinese interests, those borrowers are ineligible. And following this theme further, if a member of the board of the company is a resident of China, or the board member is required to submit a registration as a foreign agent, the company is barred from a PPP loan. If the company has a history of illegal conduct, they're barred. And again, this is a continuation from the last go round, as is the illicit industries bar that prevent gambling, massage parlors. I don't know if companies engaged in legal cannabis business are going to fall in here. It's hard to say that's illicit if it's been legalized, particularly with Congress changing the designation of marijuana, moving it from one off the narcotic schedule, but I'm sure that's going to come from further regulation. My favorite, businesses owned by members of Congress or the administration. I guess there were several members of the House and Senate and people on the executive staff at the White House who had interests in businesses that got PPP loans. And as a result of that, we now have a specific category making those businesses having those ownership interests ineligible for a loan. And the one that caused the most attention in the last go round, publicly traded companies. If the stock of your company is listed on a public exchange and its shares traded, they can't get a PPP loan. So again, this is all tailored to trying to limit the universe to the small business and to keep those larger, better funded entities with access to capital markets and cash off of the line for a PPP loan. Let's talk for a minute or two about the affiliation rules. Generally, entities are going to be treated as related and affiliated where one controls another or a third party controls both. Whether or not that exercise is controlled. Generally speaking, control is owning 50% or more of the stock of the company. So if the same person owns 50% of the stock of two companies, that's the clearest example of affiliation. Another is in the parent subsidiary situation where one company owns a controlling interest of another. But the affiliation rules also say that control can be negative. So a minority shareholder can have, under the terms of governing documents, the ability to block certain corporate action, and that could constitute control as well. But most of the situations where you're going to see the assertion of control and application of the affiliation rules are going to be by common ownership or parent sub. And that control can be exercised either directly, where one person owns the interests of two entities, or where one person controls an entity that itself owns a controlling interest of a third company, and the one individual controls all of it indirectly through his ownership of an intervening parent. So we have to take a look at structure and understand percentage holdings. And for purposes of the affiliation rules, we're also going to look at foreign entities. So foreign and domestic companies can be affiliated for purposes of these rules, and the employees stacked in for determination of whether we satisfy the size limitations. One of the exceptions to all of this is an employee leasing company and the consumer of their services. They are not affiliated. So if a business essentially rents its employees from a third party for a fee, the company with the employees is not necessarily affiliated with the company that enjoys the services. The exception would be where the same interests own both of those companies, but merely engaging in an employee leasing transaction is not enough to fall on the wrong side of the affiliation rules. So I've mentioned once or twice that under the new provisions, the amount of the loan has been reduced. Generally, the loan amount is going to be 2.5 times the 2019 average monthly payroll. So there was some confusion over the first round whether the average monthly payroll was the 12 months ending the month before the application was submitted, which is what the statute literally said. Most lenders were interpreting these provisions to be the 2019 calendar year and determining the payroll for the prior year. The new statute looks specifically at 2019, so there's no question there. So add up your total payroll in 2019, exclude any compensation to individuals over $100,000, divide by 12, multiply by 2.5, and there's your loan amount. Borrowers with the NAICS code of 72 can borrow 3.5 times average monthly payroll. So there's potential for a larger loan amount, but all loans are going to be subject to the same $2 million cap. So while the NAICS 72s can get 3.5 times their payroll while everybody else is getting 2.5, nobody can get a loan for more than $2 million. Seasonal employers got a little more attention in this go-round. For purposes of determining the monthly payroll, seasonal employers can use any 12-week period during the 12-month period beginning February 15th of 2019. So put together the the 12 consecutive weeks that yield you the highest payroll amount, come up with the average there, and you can use that as your base if you're a seasonal employer. As I already mentioned, the loan amount is capped at $2 million, one loan per eligible borrower, and borrowers can participate in round 2, even if they participated in round 1. Let's talk a little bit about payroll expenses that get factored into the determination for the loan amount. As I've already mentioned, gross employee payroll is limited to $100,000 per employee. Amounts in excess of $100,000 are excluded, but you still get credit for consideration in the payroll up to the $100,000. Payroll includes salary, wages, commissions, tips, payment for vacation, parental, family, medical, or sick leave. And again, this was the same thing that we had in the CARES Act loan amounts. Amounts paid for dismissal or separation, union dues, as well as the wages used to collect the employee retention credit, as I had mentioned earlier. Most employer payroll expenses are going to be includable in the wage base, but not the fees that the employer pays to a third-party payroll service provider. So the amount you pay to ADP for the benefit of having them do your payroll, that doesn't count. What does count, beside the salary, wages, and commissions, are the employer cost of benefits, the employer contribution to health and retirement, with an exception that we're going to talk about in a minute for owner employees. Employer contributions to state and local employment taxes, federal taxes do not factor in here. Federal taxes do not factor in here. The employer payment of group life insurance, also eligible, and employer contribution to retirement benefits, also a good expense. The $100,000 cap on employee compensation does not limit the employer cost for these other payroll expenses beyond salary, wages, commission, and tips. So if an employee is paid over $100,000 a year, while their wages are capped at $100,000, the other costs associated with the employee for their health benefits, retirement, life insurance, so on, those are included for purposes of determining the average monthly payroll. If you remember, there's always limits on owner compensation, and I basically lifted this chart from another presentation, looking at how are we treating sole proprietors, partners, shareholders in an S Corp, and shareholders in a C Corp. The most generous treatment is for the shareholder employee in a C Corp, where we're looking at 2.5 times 12-month average of 2019 compensation. All the health costs are eligible, and retirement has its cap integrated with the compensation paid to the owner employee. The other categories have limitations on health benefits. The S Corp has a limitation specifically. Partners in a partnership and sole proprietor can't use their own costs for health insurance and for retirement benefits. They're essentially limited to the 2.5 times the 2.5 times the average of monthly compensation, with an overall cap of $15,385 on what can be considered for the owner-employee. My favorite is what I call the do-it-yourself covered period. So the CARES Act provided borrowers with 8 weeks to spend loan proceeds to qualify for forgiveness. This the legislation refers to as the covered period. Originally, if you had any loan proceeds after the end of your covered period, you could spend it on eligible expenses through June 30. The amount that you spent from the end of the covered period through June 30 couldn't be forgiven. You'd have to pay it back. First over 2 years, and then that got expanded to 5 years. And that was our original provision. The Flexibility Act pushed the covered period to 24 weeks, and borrowers had an election to use 8 weeks. Most of the borrowers who elected 8 weeks were able to spend their money in 8 weeks and wanted to be done with this process. So under the new legislation, borrowers had their dreams come true. Borrowers were asking in the course of the seminars that we did over the first 5 months of the program, I'd like a covered period of 10 weeks or 12 weeks or 16 weeks. 24 weeks is too long. I'm going to run out of money, and then I'm going to have to deal with all of these penalties. And I was closed for 7 of the first 8 weeks, so the 8 weeks doesn't work. Here, Congress did all of those borrowers a solid, provided that they didn't already submit their applications for forgiveness. The covered period is going to start at origination, and a borrower can pick a covered period that ends anywhere between 8 weeks from origination and 24 weeks from origination. So the borrower who wanted 11 weeks, you got it. The borrower who wanted 17 weeks, she got it. The company that wanted 13 weeks, it's theirs. The election of the covered period is going to be identified on the application for forgiveness, and the borrower is going to choose this. So this is one of the great provisions that were included in the new legislation, and which will provide some significant relief to a number of borrowers. Again, provided that they follow the advice that we've been giving out for months, which is wait for this legislation before you submit your application for forgiveness. It's going to be worthwhile. The best part of all of this is that if you select the 13-week covered period, you're no longer accounting for the changes in your payroll and in your FTE after the end of your covered period. So if you spend everything in 13 weeks, you don't have an FTE reduction, you don't have salary reduction above 25%, but 2 weeks after your covered period ends, you cut your staff in half, and the remaining staff you have, you reduce their salary by 50%. You're not going to suffer any penalties because of it. So the end of the covered period that you select also cuts off the period for further analysis under the penalty provisions for forgiveness. And I don't want to go too far into forgiveness provisions because on Thursday we're going to take a deep dive there. But you know, some of the Flexibility Act provisions that allow you to create correct staffing issues also cut off at the end of your selected covered period. So there's a lot of good that flows from this do-it-yourself provision. There's also some tax issues that got resolved. Some of you will remember that the CARES Act provided that loans that are forgiven don't give rise to taxable income. There's a provision in the tax code that deals with what's called cancellation of indebtedness income. If you owe somebody $100 because you borrow it and you don't pay it back because the loan is forgiven, the law says you have $100 in income. The CARES Act said that if a loan is forgiven, you don't treat the forgiveness as taxable income. So there was one benefit in the original legislation. So the IRS, of course, is reading that original legislation, and anybody from the IRS listening, the Scrooges that they sometimes are, announce that expenses that are paid with PPP funds can't be deducted for purposes of determining income tax. So if you got a $100 loan, $100 PPP loan, and you used the proceeds to pay salary, you couldn't claim an income tax deduction for the $100 in salary that you paid with those funds. A lot of taxpayers, a lot of borrowers thought this was unfair. IRS's justification was any other rule amounted to a double dip. That is, you got free money and then deducted the expenses that you paid with the free money. IRS said, if that's what Congress intended, Congress can do that. Well, guess what? That apparently is what Congress intended, because under the Consolidated Appropriations Act, Congress has reversed the IRS on deductibility. So expenses that are paid with proceeds of a forgiven loan are deductible now. So no income recognized when the loan is forgiven, no limit on the deductions that you can claim, again, provided that they're ordinary and necessary. But if you use PPP loan funds to pay expenses that are usually deductible, you now can get those deductions. There are provisions in the tax code for pass-through entities, such as subchapter S corporations and entities taxed as partnerships, which would include limited liability companies, that allow the owners of those companies to change their tax cost or basis for amounts borrowed by the entity. Those rules don't apply to PPP loans. So the company is going to be treated as if there was no change there, that as if the loan didn't exist. But that's a pretty limited provision, and just something for you to carry back to your tax advisors. Spending categories. As I mentioned a couple times, you can spend money on more things to get forgiveness. And again, this is another area where a lot of borrowers were saying, I spent all this money to make my employees safe, to protect my employees from my customers and vice versa, and I can't use any of those expenses with the money that I got from the government. Well, that's changed. So all of the original CARES Act permitted expenses continue as good spends. Employee payroll, rent, utilities, mortgage interest on business property, equipment lease payments, fleet maintenance costs, and fuel for those companies that operate fleets of trucks and cars, plus this whole new category. And again, I said I wasn't going to get too far into the forgiveness provisions, but you need to know what you can spend this money on before you get to forgiveness. So the spending categories have been expanded. Costs related to software or cloud computing services that support business operations, products, delivery, payroll, HR, accounting, or expense management are now all eligible expenses for purposes of determining forgiveness. Amounts paid to restore property damaged and vandalism done due to public disturbances in 2020, not compensated by insurance or otherwise, are all considered good expenses for determining forgiveness. A cost of goods that are essential to operation of a business, or for perishable goods, fruits, vegetables, dairy, chemicals that need or substances that require certain temperatures to retain their vitality. Pursuant to contracts or purchase orders that were made during the covered period are all eligible expenses for purposes of determining forgiveness. The expenses which an employer pays to comply with health and safety requirements, issued during the pandemic related to sanitation, social distancing, worker or customer safety requirements that include, but aren't limited to this list, physical barriers, drive-through windows, air pressure and air handling equipment, ventilation, filtration systems, or personal protective equipment are now all eligible expenses for purposes of determining forgiveness. The forgiveness process, preview of Thursday, this has been revised as well. Stay tuned to the presentation on Thursday. We're going to go into in detail all of those provisions, and I assure you there are some additional surprises in there as well. Now, the legislation requires the SBA to release some new forms and some regulations within 10 days of the passage of the Act. So 10 days is this week. I think we'd be lucky to see anything from SBA this week, but there's going to be more information out there. There's going to be more changes, just as we saw in the first go-round here. So we are going to stay on top of this for you and continue to bring programs. I thought it was important enough to start to get out the information on the Change Loan Program so that borrowers can get a head start on this process, understand that there's new money coming and there are benefits in this new program. It's going to be a little bit more restricted, but the opportunity to spend new funds on expenses to keep your business open, I think is worthy of pursuing. So at this point, what I'd like to do is open the floor to some questions. I know that Dana has been collecting questions, and we'll try to answer as many as we can in the limited time that we have this afternoon. I'd like to focus on the new program if we can, and we'll deal with forgiveness on the next side. Dana, what do you have?
So the first question I have is, can we use any unspent funds from PPP Loan Number One during a second loan?
No. Most of the covered periods, even if you elected a 24-week period, are over. So you're only authorized and eligible to spend money from a PPP loan within the covered period. So if you've gotten to the end of your covered period, you have money that you haven't spent, you need to turn that back to your lender and apply for another loan.
Can you clarify if the new revenue test is based on gross or net revenues?
It's gross revenue.
Are equipment lease payments still permissible expenditures?
Yes, they are.
What are our options if we have unspent funds we couldn't spend within our 8-week counting period?
I don't think you have a lot of options. If you got it early enough in the first round so that you had some time between the end of your covered period and June 30, you could continue to spend on eligible expenditures, but you'd have to pay those amounts back now over 5 years. So that's one option. If you got your loan later or you elected a 24-week covered period and you got past June 30, your option there is to return the unspent proceeds to your bank.
If you did not borrow the full amount you were eligible for in the first round, are you still eligible to apply via the second round?
Well, the second round has a different look. It still uses the 2019 period to determine average monthly payroll. Assuming that your loan was under $2 million, if you satisfy the revenue test, most borrowers are going to be eligible for the same loan amount under the new program as they were under the old program. If you had trouble spending the money under the old program, look to the new roster of expenses that are now eligible, and that might help you spend proceeds. For those of you who are having trouble spending money on payroll and the definition of eligible expenses, but you spent money on cloud computing services or to restore damage done in civil unrest, or on PPE, personal protective equipment, and you spent that in the covered period and you haven't submitted your application yet, the expanded roster of expenses are eligible for forgiveness under the first program. So the question will be, did you expend the money in the covered period? If you did, the new legislation gives you a bit of a benefit. So even those individuals who had trouble submitting substantiation up to their loan amount, where they spent 60% on payroll, but they were having trouble filling their 40% basket, they might find that they can get forgiveness for the entire loan.
Do seasonal employers have to use the same time period they used to calculate their employee count as they did during the first round?
No.
Are businesses that file Schedule C or K only eligible for the new round, or are 1120s eligible?
No, 1120s are eligible as well. And 1120s, Form 1120 is the federal corporate income tax return.
Is the 2 million cap cumulative, or is each individual loan, or sorry, can you apply for multiple loans?
So the same entity can only apply for one loan under the second program. If you applied for a loan under the first program, that's the first program, close that chapter. You can apply for another loan under the second program, so long as you apply once, you're fine. But the same entity or member of the same affiliated group cannot apply for more than one loan unless one of the exceptions from the affiliation rules apply.
If a nonprofit received a grant outside of the PPP for payroll, but those funds have been exhausted, can it participate in the next PPP round?
It can, so long as it doesn't have an expectation of getting another grant to cover the same expenses.
What basis is used to define revenue? Is it a tax basis for tax reporting or a book basis?
I believe it's going to be tax.
Does the time frame have to be exact quarterly days, or can you use March through May, for example?
I presume the question is in testing for revenue. And what the law provides is quarterly comparisons. So first quarter, January 1 to March 31, second quarter, April 1st to June 30, and so on.
Are residential housing condominium associations eligible for PPP Round 2?
Well, the law allows housing cooperatives other owners of or managers of real estate are eligible. So a condo association, I guess a condo association owns the common elements in the development. Most condos have fairly limited number of employees. Most of it's done by contractors. So I would think it would be difficult for the condo association, unless it was particularly large and had its own employees, to come in with any sort of payroll number that would entitle it to a loan. That question's probably close enough to the line to merit some further review. So if the person who sent it in wants to contact me offline by email, I can take a look at it, but that's an interesting question.
If a company got a PPP loan in Round 1 and is eligible in Round 2 and got an EIDL grant, are they still required to deduct the amount of the EIDL grant when applying for forgiveness for Round 1?
No, Congress has given up the requirement to recoup EIDL grants by reducing the amount of otherwise eligible expenditure for purposes of determining forgiveness. So if a borrower got a $10,000 loan, I'm sorry, a $10,000 EIDL grant and a $100,000 PPP loan and spent the PPP loan properly prior to the passage of CAA, they would get $90,000 in forgiveness, which would effectively recover the amount of the grant. What Consolidated Appropriations Act did is say the grant is now free also. So the borrower who spent $100,000 properly and got a $10,000 grant would get $100,000 of forgiveness and would not have to repay the grant.
Do you have any idea what the staffing expectations are for Round 2?
By staffing, I'm guessing the questioner is looking to bank staffing, and I have no idea. The banks are caught in a bit of a crunch now. A lot of borrowers have submitted applications for forgiveness, and a lot of their staff has been devoted to handling the crush of forgiveness applications coming in. The individuals who staffed the original funding functions of lenders moved from funding to forgiveness. Now, just when they've started to get their feet wet in forgiveness, they have to go back into funding. So the lenders are going to be hard pressed to keep up with the flow here. I think Congress has tried to make it somewhat easier, particularly on the smaller loans, the loans under 150,000, where the applications are going to be greatly simplified, and it's just going to be a bunch of signatures. So you put in this one page, and you should get a loan. Trying not to make a bad situation worse as far as staffing, but I can't tell you specifically how they're going to handle this.
When are you able to apply for the second round?
Well, I think all of the lenders are waiting until the SBA comes out with another round of interpretive regulations, which is supposed to be in the next couple of days. One of the things the SBA is going to release is a new form for loans under 150,000, as well as for loans between 150,000 and 2 million. So at the very least, we're waiting for those forms to come out and the banks to include those fields on their platforms for the loans. And I think each lender is going to have a different deadline. So we've got to watch the lenders generally. Stay in touch with your lender. But I think, we're going to see kind of this rolling opening of portals, and no 10 lenders are going to have the same date. So everybody is trying to react as quickly as they can to get this done. But borrowers are going to have to rely on each other to share information as they learn it. Hopefully the banks communicate this to the world, but we'll have to wait and see.
For a sole proprietor that does not draw a salary, can 2019 Schedule C net income be used as sole proprietor compensation?
Yes.
I am an LLC. I take a draw as the owner. How do I factor that amount into the average 2019 payroll to determine my loan amount?
Well, the owners of a limited liability company technically aren't supposed to take salary. They get distributive share of the bottom line earnings of the company. So they're limited to 2.5 times the average 12-month compensation or the 12-month earnings of the company from the 2019 year, to a cap of 20,833, which should be the biggest loan that they can take. But that's that's how you'd figure it. It's the distributive share of earnings of the company. How about one more, Dana?
For PPP round one, you could include some cloud-based computer costs like accounting or payroll software. Is it true, or if that's true, can I go back to PPP one and retrofit these new expenses into my total since I haven't finished the forgiveness application yet? I actually think they meant PPP round two includes cloud-based computer software.
Yeah, if you haven't submitted your application yet, but you paid the expenses in the covered period that you selected, then yes, you can include those costs in your round one application. You just have to keep in mind the 60-40 split. You still have to have no more than 40% of your expenses on non-payroll costs. And if you check all those boxes, then you'll be fine. So I want to thank everybody for joining us today. We'll be back, believe it or not, on Thursday with another program highlighting the round two changes to the forgiveness process. A lot of the questions that folks were asking today are more tied to the forgiveness program. We'll be slicing and dicing all of that up on Thursday afternoon. You have my contact information. One of the things that kept me busy the last 6 months was responding to the emails and inquiries from all of you, and very much enjoyed meeting so many of you electronically and trying to give you some practical tips to work through this program. We're here when you need us. Please feel free to reach out. Hope to see you all again on Thursday, And thanks again for joining us. Have a great day and be safe.